Welcome back to for a subsequent presentation on the introduction to management accounting. Of course, in our last presentation, we did look at the overview of the syllabus, and so from this presentation or from this video onward, we're going to be looking at the real issues of management accounting as far as your part 2 paper here is concerned. Of course, don't forget that this is, let me say, it's an advanced management accounting because you have already studied the principles of this paper at level 1. And so here we are building on the foundation that you have had from level 1. All right. So in this presentation, we're going to quickly take a look at some introduction to management accounting. And here it will be a bit, we're going to take a bit of what you have studied from level 1, and then we build on it to see the real issues or real, the factors to consider or the various areas for consideration as far as this level management accounting is concerned. All right. So let me start by saying that management accounting, as the name suggests, simply means the accountant for the management or the accounting for management. Oftentimes we hear people say, or it is said, accounting for a non-accountant. Okay, so here it's a point where you're going to act or you're going to deliver your service as an advisory individual or entity to the management that you are working with for. Because not every manager may have an understanding of the concept of accounting. And so here your position as a management accountant or accountant simply means that you're going to analyze the various information as far as areas of cost is concerned and other disciplines are concerned, and put them together in a manner that's understandable to the management, and you're going to advise them accordingly in that regard. All right, so before we get into details of this presentation or this video or this discussion, let's simply go through to look at the learning objectives, what we seek to achieve by the end of this discussion or this video. Okay, so here we seek to achieve the following objectives or target. So by the end of it, you would have gotten to understand basic principles regarding accounting and its purposes, the meaning of cost and costing. Okay, of course, the two words mean different things altogether. Cost classification and cost separation. In other words, how are you going to separate costs into various components, the basic rudiments of cost accounting, the management and the use of management information, the links or the contrast among levels of accounting and levels of management, the management information and lines of communication. Also look at issues regarding professional ethics and potential threats. It's important for you to know that once you become a CA or otherwise, you are still a professional. Okay, so in your line of duty, you're expected to comply with certain code of ethics. So you don't even have to be a chartered accountant. You don't even have to be a member of a certain professional body. As far as you're acting in your normal dealings or dealing with other people or third parties, you must always exhibit those lines of professional ethics and a code of conduct, and also be aware of certain potential threats as they come about, so that a minimum acceptable level, just so you don't jeopardize on your professional integrity or of a sort. Right, now let's get into details. Okay, so management accounting has two sides. We have the management part of it and you have the accounting part of it. So here you are more or less a manager and also an accountant at the same time. So two different disciplines put together, and that is what is going to be clothed on you. And so you have to exhibit the qualities of a manager and also exhibit the qualities of an accountant. Even though in most of your dealings, you're going to always play the role as an accountant, but because you're dealing with the management of your enterprise, it's always important for you to combine both professional qualifications, just so you know how to deliver your lines of responsibilities or duties to fulfill the expectation of your management. All right, so when you say accounting, what is an aspect of management accounting, or what is a branch of accounting? Of course, from basic understanding, we know that accountant is always acting as a steward, simply because accountant is always engaged by the manager of the company in order to manage the resources of the enterprise. So at the end of the year, or at the end of regular intervals, you're going to give an accountability of your stewardship of those resources that have been entrusted in the care of management to the owners of the business. Okay, so the simple idea, the simple concept of accounting is just simply mean stewardship or being a steward over the resources that have been entrusted into your care. But of course, the accountability aspect of this accounting profession is where you're going to give that stewardship information irrespective of the fact that this information is going to be used by the various users of the information or the financial information to make relevant what decisions. So the bottom line of your accounting professional, your accounting functions or job is simply to communicate relevant information or economic information that will assist the management or the users of the financial information to make most important decisions. Okay, so shareholder, for instance, a stakeholder, when they get access to this information, they're going to decide whether the company is really doing well and whether or not they have to invest more into the company, and such other stakeholders who may equally be important in applying the information that have been given by the accountant or the accountant in general. Okay, so it's just the process of identifying, measuring, classifying, and communicating economic information that permit informed judgment and decision by the users of the financial information. So like I said, all that have to do, regardless of how you started, regardless of the process that you apply, regardless of the procedures that you adopt, the most important thing is that you're going to give information that is acceptable, that is informative, that is relevant, so that the users of the financial information you are churning out as the accountant. Of course, the managing accountant is equally is an accountant, of course, but your lines of responsibility or reporting are different from a normal financial accountant. So accounting in general has three key branches. Of course, in the contemporary world, in the modern world, we're going to have different aspects of accounting. But traditionally, we need to understand that accounting has three phases or three segments. We have the issue of cost accounting, the management accounting, and financial accounting. Of course, in the way that have been enlisted in this slide, it equally explains the lines of communication. It explains how they are dependent on each other. Okay, it does not suggest that one is important than the other. Even they are all line managers, but where one person's or one branch of accounting functions ends, that's where the other person also will start. So if you look at how they have been enlisted, that what means that the cost accountant always asks the basics. Is form the basis of the other accounting profession or other accounting branches or discipline. So here what simply means that the cost accountant simply gather the basic cost information and analyze and put out the relevant information. But of course, if there's an information coming from the cost accountant, it rather represents that input to the marginal accountant. So what the marginal accountant simply does here is to pick this information, analyze them, adapt them, and put out information or outcome that is relevant for management decision. Now, the decisions that are made by this management are what is reported in the form of a financial statement by the financial accountant. So that explains the link between the three levels of the accounting. So the cost accountant starts the work, he ends the work, and that is transferred to the managing accountant. The managing accountant rather process them and put them in a more informative decision-making manner or content, and then the financial accountant picks it up based on the outcome of management decisions and report them in the form of financial statements. So it means that if a company is going to make important decision by the management, it depends on information that is coming from the management accountant. So it simply explains how important your role is as a management accountant. Because if the information given to the management is not right, is not accurate, is not reliable, you're equally going to make the wrongful decision. Of course, like the saying goes, garbage in, garbage out. So all that the financial accountant that is reported in the form of a summary. Okay, so if the decision made by management of quality, of value, of returning value to the company, obviously going to show in the bottom line in the form of profit. The financial accountant doesn't do so much work, okay? Because the work of the financial accountant is always structured. It's always guided. It's always so to say they have principles underlying them. Okay, so for them, they simply report as they see. But whatever they're going to report as they see depends on what is coming from the marginal accounting systems. All things we have as far as accounting in general is concerned. Now, for us to appreciate the work of marginal accounting as far as this paper 2.4 is concerned, it's important for us to appreciate the concept of cost accounting, because we are saying that the function or the work or the responsibility of the management accountant depends on the function of the cost accountant. So whatever information that the cost accountant is going to deliver, is based on which is the management accountant going to adopt them and then reports in the form of a decision-making tool for the management to make the relevant decisions. Okay, so it means that the management accountant is equally a cost accountant, because if you don't understand the work and the outputs from the cost accountant, there's no way you can use them and present them in a manner that will be understood by the management of the company or the enterprise. So let's take a look at the simple concept, the basic rudiments of the term cost accounting. Now, for us to understand even the cost accounting, of course, we already know what accounting is. So what we need to add up is the term cost, right? So when you say cost, cost simply means how much has been spent or how much will be spent. So it's either what is yet to be spent or what is yet to be incurred or what has already been incurred or what has already been done. So it's in normal terms, in principle, we say that cost is the amount of expenditure incurred in producing an item or service. The amount of expenditure incurred. Okay, so the amount of expenditure incurred or about to be incurred or yet to be incurred could either be an actual cost incurred or notional what cost. It's important for us to know that when you say cost, it is not just limited to the out-of-pocket what cost. It's not just limited to how much cash has been spent. It also goes to the extent of what has not been spent but otherwise would have been spent. Otherwise referred to as notional cost, opportunity what cost. Okay, so whenever you're calculating the cost of a service or the cost of a product, you don't limit yourself to just how much has been spent as out-of-pocket costs. You must also go to the extent of what other costs have been forgone, or what other alternatives have been forgone. Or, for instance, if you occupy a building for your business, you do not pay rent, because if you had rented the place from a third party, would have paid rent. But it's important for you to measure your profit by incorporating the concept, the fact that if you had actually rented this property, you would have actually paid your rent. So if you also look at the alternative, the opportunity what cost, the forgone what cost, and that forgone cost is what you say here as well, the initial cost. So that gives you a bigger picture to know whether you are making profit or not making any profit. So in calculating your cost, your true cost, as it said, you must always look at the case of the actual expenditure incurred plus the notional expenditure, which otherwise has been forgone, otherwise referred to as opportunity cost. Sometimes the same cost can also be referred, as you know, in financial accounting or financial reporting, as amount of expenditure incurred in bringing an item to a present location or condition. Okay, so like when you buy a property, maybe when you buy a car, when you buy a fridge, the cost of the fridge is not just limited to how much you paid for the fridge. It also includes how much it incurs or how much you incur in bringing the fridge from wherever you bought it from to the intended place where it is meant to be used. So the transportation, the installation, the fixing, and all that you have to do to get the fridge to a present location and condition constitute the total cost of the acquisition of that fridge in question. So it's either how much has been spent or how much is yet to be spent or what has been forgone for taking a particular decision. Okay, so for instance, if you take your ICA profession, if you want to calculate the cost of this profession or this course, it's not just limited to how much you would have spent on books, how much you would have spent on tuition, or how much you pay in terms of transport, either your personal car or public transport or whatever means of transportation you get to the tuition center. You must also look at other costs forgone. Because see, you go for lectures maybe every weekend. Okay, now that weekend is the time that you would have used to rest. That's a weekend that you would have used to attend other events. That's a weekend that you would have used to do other things. But in this case, every Saturday from morning to evening, you are at the lecture hall, you are at the tuition center. Okay, so when you're calculating the cost, it's not just limited to how much you paid in terms of books, how much you paid in terms of tuition or any other expenditure you have incurred. You also have to look at other alternatives forgone, other costs that you have also incurred indirectly or directly. Okay, so you can look at the extent of how much time that you spend at the lecture hall as a cost incurred, how much friends or how many friends you're losing because you have engaged yourself busily and all those friends are not getting to have parties with you, or those events that you may have decided not to attend. To the extent that sometimes on Sundays you even go to work, you don't go to church. Okay, so when you're calculating the cost of this professional program, of this decision you have made, you have to look at in totality, in the total picture, by adding the out-of-pocket cost plus the alternative plus the opportunity cost. Okay, so that's a classical example of what cost actually means to say the actual expenditure incurred or the notional expenditure that is also what incurred. So the notional may not represent an out-of-pocket cash spent or money spent, but other alternative, other decisions that have been forgone, all things being equal. Right, now that we know the meaning of cost, let's see another terminology referred here as costing. Okay, so as the name implies, costing is a process. It's a process. So we can say costing is an action verb. It's an action word. You are doing it. You are in the process of bringing out something. So when you say costing in money accounting or cost accounting and accounting in general, it simply means the process of determining or ascertaining the cost of an item, of a product. But you see, if you look at it, costing, it means you are just determining just the cost. But it's even though the name costing sounds to me like coming from the word cost, the word costing goes beyond just knowing what it costs. Costing means knowing the cost of the item, knowing the selling price of the item, to the extent of also measuring any amount of profit or loss that may come out of what? The whole process. So it means looking at the bottom line, which is either a profit or loss, measured as your selling prices minus what? Your cost. So every time you are asked to do cost or cost a product, or you are in the process of costing a product or service, it means you are determining the cost of the item. You are also knowing the profit or the loss from the item to the extent of knowing the selling price from the item. But of course, costing is done or can be done using two different approaches. We have what is called costing methods and costing techniques. Costing methods and costing techniques. Now, when it comes to money accounting, if you look at your syllabus, the costing methods have been studied at level 1. So when it comes to level 2 here, our focus mainly going to be on costing techniques. Now, what does it mean, say costing methods? So costing methods means the methods that are used to determine the unit cost of cost units. Okay, so when you are determining the unit cost of a cost unit, that process or that approach that you adopt is referred to as a costing method or costing methods. Okay, so if you want to know the price of a table, so let's say you are a cost accountant for a carpentry shop, and your management has asked you to cost the table that the company is producing or manufacturing. Okay, so you want to know the cost of the table. So you're producing a number of tables. The basis of your costing or the essence of the activities that you engaged in is know the cost of something. So that something here is a table. The table in question is what referred to as the cost unit. The cost what? Unit. So if you want to know the cost of every student as you lecture them, the student represents the cost what? Unit. So everything that you produce or you render as a service is what you want to determine the cost for. So the item for which you are determining the cost for, or the item to which the cost is associated or related to, are what referred to as what? Cost what? Unit. But every cost for the unit, every cost for the student, every cost for the table, that cost for that unit is what referred to as what? The unit's what? Cost. So another word for unit cost, another word to say unit cost is what? Cost per unit. Cost per unit. Okay? So the cost per unit. Right. Now, what about, so in terms of the costing method, there are a number of costing methods we can adopt. Okay? So we can look at the case of job costing, all right, as a costing method, batch costing as a costing method, process costing, service costing, contract costing, and so forth. Okay, so now you know that at level 1, some of these methods were well studied. So you know that, okay, all that you did at level 1 were costing methods. So you realize that the end results of these methods application were meant to determine the cost of something, the cost of a product, the cost of what? A service. Cost to determine how much is attributable to a unit of the cost of what? Unit. On the other hand, costing techniques are methods that are used, or the approaches that are used to gather information, all right, for management decision-making purposes. They are the methods or the tools that are used to collect information for decision-making purposes. So, of course, if you look at it from this angle, management accounting is mainly meant for decision-making purposes. Management accounting is meant to advise management to make the relevant or important, decisions or choose from alternatives, all things being equal. So, if looking at costing methods as a way of collecting information and helping management to make the information, then obviously means that your management accounting here will focus mainly on these costing methods. And of course, costing methods can include the use of marginal costing, absorption costing, standard costing, budget and budget control, performance evaluation. All these are costing techniques. All right. So that's what I mean to say. And the process of determining the cost is referred to as costing, and costing can be done using costing methods and costing techniques. The methods determine the unit cost, whilst the techniques are meant to determine or meant to gather information for decision making purposes. And you have also gotten to see examples of costing methods and costing techniques. Now let's get to understand the term or the subject cost accounting itself. So over here is saying that cost accounting is the application of costing principles, costing methods, and costing techniques in ascertainment of cost. Okay, so all that the cost accountant does, or the cost accounting function is up to or seek to achieve, is to use costing principles, just as we have in accounting principles, to use costing methods as you have seen earlier on, costing techniques as well, for to ascertain the cost of a service or cost of a product. And of course, also compare to whatever has been achieved in time past. So cost accounting work doesn't end by just determining the cost using costing methods, goes into costing techniques, but it also goes to the extent of making comparative analysis to know whether the company is on track or is off track. Okay, so Here, what means that an example of comparative to or past experience is the use of what? Budget or maybe standard costing. Okay, so whenever it has to do with comparative issues, you want to know whether the company is doing something right, whether the company is improving on its performance, whether the company is on course to achieve its intended purpose in the short term, in the medium term, or in the long term. So the whole idea of cost accounting is to apply the costing principles or methods or the techniques to ascertain or to know the cost of a service or cost of what? A product, and also for comparative analysis to know whether we are doing something right, we are saving, we are making losses, and what like. So that's what a cost accountant simply what does. All right. Now let's see then what is management accounting. Because we are saying that the flow of information always commencing with the work of the cost accountant. So now that we know what a cost accountant does, let's see what a management accountant also does. Okay, so what the management accountant does is simply to adopt or to pick the information from the cost accountant, put them in a manner that is understandable to management, and then present them for decision-making purposes. Okay, so it's important for you to know that your job as a management accountant is very key to the company survival. It's very key to the company success, because the quality of information gives your management decide the quality of decisions that they make. So that's why we are saying that it's important for you to appreciate the work of the cost accountant, because if you know, all things being equal, what your junior does, you can always pick it up and put them, adapt them in a manner that can be reanalyzed for decision-making purposes, or can be reanalyzed for whatever intended purpose that the management may want to use that information for. So here, one reason why we say that management accounting is very difficult, as is always heard from various cycles, that maybe if you compare management accounting to financial accounting, it's always easier for a financial accounting student to pass the paper as easy as possible. It's always easier to get a more than 50% financial accounting. But why is it not this? Why is the same thing not said for management accounting? Simply because management accounting lacks structure. It doesn't have the structure. Unlike financial accounting, that you are always made to comply with certain principles, certain structures, certain procedures, certain methods. Management accounting do not have any of those. So if you look at the management accounting definition, we are saying that it's the application of professional skills, professional knowledge, and understanding in the preparation and presentation of financial information for management decisions. Okay, unlike maybe your normal financial reporting where you are told that you have to comply with this kind of methods, techniques, approaches like IFRS, like IAS, and the likes. When it comes to management accounting, it doesn't have so. It doesn't have anything like IAS of a sort. It requires your general understanding and skills. So it's a good management accountant must always exhibit agility. You must be flexible. You must have unlimited knowledge. Because if you look at them here, the definition, you are saying that includes the application of professional skills or professional knowledge. Now that clause as stated here means that it's not just limited to professional skills as in accounting or as a CA. You must go to the extent of even applying economic skills. It goes to the extent of applying legal skills. It goes to the extent of applying HR skills. So every skill that can be exhibited from any level of professional qualification or arena would have to be adopted in management accounting decisions. Because every decision that a management is making would have more implications, just far more than financial issues. It goes to the extent looking at implication on human being, because if you want to shut down a company as a key decision making, it's not just looking at, okay, shutting down saves more money, saves more cost for the company. It goes to the extent of the implication on the society. It goes to the extent of the implication on the various stakeholders that can be affected as far as that shutdown decision was concerned. So it's important for the management accountant to be all round, all 365. So it means that if you want to perform the function of management accountant, you just have to move away from the box, just move away from the normal accounting profession and adapt other professional skills, knowledge, understanding, so that you can advise on management as much appropriately as possible. So like I said, you must always be flexible, you must adapt, quick to changing environment, changing issue, changing fact, because whatever you did yesterday, when the same fact presents itself, the approach will change. Okay, so if you take a management accounting question, resolve question 1 using different principle, different approach, it's the same. You can get another question from the same topic, but the approach might change because the content have changed. But of course, if you take financial accounting, for instance, financial accounts or final account, right? Question 1, same, you start with sales. Question 2, final account, the approach is the same, you start with sales. But when it comes to management accounting, the same topic, different questions, and the approach are different. But one thing that runs through all the questions in terms of solution is understanding. So when you have your level of understanding, you are that flexible, you have that unlimited knowledge and understanding, you are very analytical and non-conformist. All financial accountants are conformists because they conform to certain what standards, IAS, IFRS, and that's what it is. But when it comes to money accounting, there's nothing of such. You do not conform to anything because it requires general knowledge, application, and what? Understanding. So you need to be someone who is what? Flexible, who's adaptable, and willing what? To change. All things being equal. So on that basis, let's find that there's some differences or maybe distinction or contrast between a marginal accounting and financial accounting. So like I said, for instance, financial accounting always must have to comply with statutory requirements. It's required by law. Okay, so that's why every time, if you look at the Companies Act, says that companies are required to maintain proper books of what? Accounts. When auditors write the opinion, they say that the records have complied with the statutory requirement, and that's the nature of financial accounting. But when it comes to financial accounting, there's nothing like what? Being governed by any law or statute. There's nothing like that. So it means that it's not even compulsory for companies to have a marginal accounting system. But of course, looking at how we have explained that the concept of marginal accounting is so important that companies that are ready to make rightful decisions have some marginal accounting systems in place to make those decisions. Again, financial accounting is mainly for external reporting. Okay, so we prepare the financial statement in a certain structured manner, for the users of that information. But money accounting is only meant for internal use, for management decision purposes. Financial accounting would always have to comply with a general accepted accounting principles. But of course, like I said, there's nothing like accepted principles in marginal accounting. It's you applying your professional skills, you applying your professional knowledge. And if you look at the fourth point, especially on the money accounting, it says draw inspiration from other disciplines. Draw inspiration from other disciplines. This means that financial accounting. You don't draw inspiration from anywhere. You draw inspiration from your standards. You draw inspiration from your IFRSs and those accounting principles and concepts and standards of a sort. But when it comes to financial and money accounting, you would have to comply or draw inspiration or take your understanding, your skill must be exhibited from different professional avenues. Okay, so including a good accountant, a good marginal accountant must also exhibit some skills in economics, some financial accounting, yes it is, finance as it's operational research, legal issues, HR issues, everywhere. As far as that would help you to deliver on your mandate to give the rightful information for management to make the rightful decision. Now let's look at the use of marginal accounting information. So like we're saying, the essence or the bottom line of marginal accounting is report to management to make the rightful or to make relevant decisions. So what are the use of this marginal accounting information? So marginal accounting information can be used to achieve the following purposes. One, to ensure cost control. Cost control. So as the name suggests, controlling costs means that making sure that the amount of expenditure the company intends to spend or intends to incur is within a certain is within a certain limit. It's up to a certain ceiling. So it means that you can decide to budget that, okay, on transportation, this is how much you want to spend. You don't want to spend more than 100 cities. So it means that every time you're thinking of transportation or every time you're thinking of something you have planned to do in terms of cost, you also have to make sure that the cost that you have proposed to spend is exactly what you're going to spend. Okay, so cost control means setting ceilings. So company would have to have certain tools or certain techniques or certain methods through which they are able to make sure that cost that is incurred within the company are set within certain limit or certain borders or certain boundaries. So you can use systems or techniques such as budget or standard costing. Okay, so here you have set a certain limit. You have set the extent that it can go to spend and use the company resources. Okay, so that decision that you have made simply means that you're looking at controlling your cost. All right, so the marginal accounting information can be used to control the level or the amount of expenditure the company have to incur at a certain point in time. Cost control. But the reverse of cost control is cost reduction. Cost control and cost reduction, each of them means what to spend. But cost control means that you don't want to spend up to or beyond certain ceiling. You don't want to spend beyond certain limits. But cost control is to make sure that your cost is reduced. So for instance, you set your limit, you control your cost to 100 cities. So it means that the maximum you want to spend on maybe transport or maybe tuition is, let's say, 100 cities. All right, but you see, even though you can spend as much as 100 cities, you may also try to spend not up to the 100 cedis. So if you decide, okay, even though I want to spend 100 cedis, I want to make sure I spend just, let's say, 80 cedis. That decision to even spend below the limit is what refers as a cost reduction. Then you can also use the same information for planning purposes. Planning purposes. Of course, we know what planning is, because it's always said that if you plan, if you fail to plan, you plan to fail. So plan is a very important element when it comes to issues of management. When it comes to our normal routine lives, it's always important to plan. Of course, you are planning whether to produce, not to produce. You are planning whether to start a business, not to start a business. You are planning whether to shut down, not to shut down. You are planning on so many issues as far as the company is concerned. So we are saying that when you have the management information, as far as management are concerned, they have to plan using the cost information or using the management account information as have been presented to them by the management accountant. Again, you can also use it for external reporting. Of course, like you have seen from here, the distinction between financial accounting and management accounting. Financial accounting is meant for external reporting, but management accounting is meant for internal reporting for management decision-making purposes. So in this case, how is the management accountant or management accounting information meant for external reporting? Don't forget that there's that lines of communication, there's that line of there's that linkage between the three levels of accounting. So cost accountant or cost accounting information for management accounting and management accounting information for financial reporting purpose of financial accountant. So before the financial accountant can report externally, he or she requires data or summary of activities and decisions that are made by management. But of course, management cannot make those decisions if the management accountant has not reported accordingly. Okay, so the outcome of the management accounting information, based on which the management make the information, is what the financial accountant is reporting in the form of summary by way of financial statement. Then can also use for pricing decision. It can also use for decision-making purposes. Of course, the area of management accounting is mainly for decision-making purposes. So as we proceed further, we're going to see the various decisions that are made by the management in the area of make or buy, shutdown, further processing, limiting factors, constraint, using different techniques. Your management accounting topic at this level refers to as using the costing techniques are mainly meant for decision-making purposes. So those job costing, batch costing, service costing that I did for at level 1, they are no longer relevant at this point. The only thing that is relevant from what you did from level 1 is that we are saying that management accounting is a build-up on the cost accounting, or the use of the cost accounting information. So whatever we know of from level 1, we are going to use those information as input to the management accounting systems, reanalyze them, and present them for decision-making purposes. Right. Now that we know the issues regarding accounting, now let's quickly look at the issues of management. Because management accountant is an accountant to the management. So once we know what the accounting functions are, let's also get to see the management issues. Okay, now when you say management, management simply means the optimization and application of the scarce resources of companies or of a company, of an enterprise, just so the company is able to achieve its intended purpose. All right, so the most important issue here is the fact that resources that are available to companies are always scarce. They are always limited in supply. So it's important that these resources are put into rightful use. These resources are optimized. These resources are maximized. So the concept of management here means that the little available resources, the few scarce resources that are available to management, we want to make sure that the best are brought out of these resources in terms of how we input them and how we bring them out. Okay, so we are going to advise management in this regard in terms of how the resources can be fully put to use and optimized in terms of the outcomes of the application of these resources. Okay, so as you know from from basic knowledge in management, we always been made to understand that management is a process of planning, the process of organizing, directing, controlling both human and material resources to achieve the entity's goal. So here, the management accountant is not just looking at the material resources, which is the money or the accounting part. Of course, the term accounting means stewardship. So you're accounting both on human and non-human, or human and material resources. Okay, so like we have seen earlier on, accounting information is meant for planning and all this controlling and all that. So it's important that the management accountant understood the roles of the manager, so that when you're reporting, you get to know the various lines of reporting. Now, there are 3 levels of management in this regard. And the reason why I have to know the levels of management is such that the management accountant is reporting to all these levels of management. All right, so you must know the informational needs of all these management and the reporting lines and the structure, the content, and the scope of your reporting lines. Because the way you're going to report to the top level management will be different from how you're going to report to a lower level management. Okay, so that's why it's important for you to get to know the scope of management, the levels of management, the informational needs, the content, the direction, and all that is relevant in terms of how you're going to deliver on your mandate or your lines of work responsibilities. So the first level of management here is strategic management, strategy management. Of course, the strategic management also represents the top level management, and their function is simply to make the strategic decisions. It's a level at which the vision, the mission of the enterprise is set. It's a level at which the company sets its long-term goals. It's a level at which the company decides on its mandate. It's a level at which the company decides which industry and which business it intends to get into. Okay, so all issues regarding the company, looking into the long-term, major strategic issues are all carried on at the topmost levels of management. Okay, so it's where the vision is encapsulated, is where the vision is set, is where the goals are also set, or it's the level at which major decisions are made by the company. So of course, any company that has great strategic management composition or future good prosper, because that is where whether the company can fail or the company can survive or can succeed are made. The decision regarding these areas are made at this level of management. Then you have the tactical management. So while the strategic managers are making the core decisions, for them their decision level or decisions are always straightforward. But when it comes to the implementation of these straightforward decisions, they are actually carried on by the tactical management. Otherwise, referred to as the middle managers. So there's a level at which they decide on policies, they decide on procedures, they decide on models, on how to implement the strategic decisions. Okay, so the topmost will make the decisions, but when it comes to implementation, it has to be done by the tactical manager. So for instance, ASPA can say that, okay, next year, we want to increase student membership or student revenue or Aspire's revenue or incomes by 20%. So strategic manager will just make that statement, bold statement, period. We are gone. Now, how do we make sure that this 20% increase in revenue is achieved? The implementation of this proposition or this target or this vision would have to be implemented at the tactical, the middle level of management. But when it comes to routine daily implementation of these targets to achieve this target, it will have to be done by the company operative. And this company operatives always come under the operational management. Okay, so if you look at their relationship, one makes the major decision, one implements the decision by making policies, by making procedures, by making or deciding on the tools. How do you achieve this? Whilst the operational manager makes sure that on a daily basis we carry on with the tasks. So these are the levels of management. So in this level, we are saying that the marginal accountant must know the information that are required at each level of management. So it's important for you to know how you're going to report to strategic manager will be different from how you're going to report to operational manager. The content of your information, the scope, the lines of communication, the period will always change because they are never the same. What strategic manager needs is different from what the tactical manager will need. So for instance, if I'm reporting to my line manager as compared to I'm reporting to the CEO, you can imagine the difference. How I'm going to communicate to my top manager or my line manager will be different from how I'm going to report to the company who's a CEO, because the kind of information the CEO will need to make that long-term decision will be different from what my line manager may need to make just regular routine decisions. So the distinction can be looked at in the areas of scope. So in terms of scope, you can see that the strategic manager is looking at the entire organization, but the tactical manager is looking at the department where you operate. So you see the company looks like, let's say, increase sales by 20%. Okay, the entire company must increase sales by 20%. And this is a decision made at strategic management level. But of course, if you look at the various departments, so finance department, the HR department, the operational department, the transport department, how does each of these departments come out with policies or models so as to be able to achieve that long-term 20% increment? And how do you run with the race? How do you run with this or this target? How do you run with this vision? It's going to be run by those at the operational management level. Then the structure, every time you're reporting to your strategic manager, you have to present in a more summarized manner. Okay, so for instance, if I'm reporting to my line manager, I may put it in the form of an Excel and attach as a mail. But if I'm reporting to the CEO, I cannot do that because the CEO doesn't have time to look at details. The CEO only has time to look at summary. So maybe all the detailed analysis that I would have done in an Excel, in a spreadsheet, I'll just pick them, summarize them in the form of a chart, summarize in the form of a table, something that he can easily look at it and make decision out of it. Okay, so always strategic managers require information in a more summarized manner, but of course, tactical managers need them in a more detail, also for the operational management or operational levels of management. Then relevance, This one looking at the long term, the medium term, and the short term. So this is how you must understand the relationship that exists among the various levels of management, and how, as a management accountant, you're going to report and help them to make the relevant decisions, or assist them to make the relevant decisions. Right. Now, as we know, as in management accounting is meant to communicate information for decision-making purposes, it's important also for us to get to know the kind of the features or qualities that information that needs to be churned out would have to possess. So you're looking at the qualities, the features, what makes information relevant, what makes information of value that are important to management to make, whatever decision that they need to make those decisions with. All right. So a management accounting information or accounting information would usually have to exhibit a feature of relevance. So the term relevant means that if the information you're giving to the management or whoever you're communicating to that information, the information cannot influence the person's judgment, then of course that information regarded as irrelevant. So relevant means that whatever I receive as information must affect my thought, must affect my judgment, must have that kind of significance, must have that kind of influence. So sometimes when you're speaking to someone and you say something and the person says, okay, what you said is not important, what valid. Now, once a person makes or exhibits that kind of gesture, all that is simply the person trying to tell you that under the circumstance or for whatever needs, the information that you have given out or you have churned out there is not relevant, it's not important to that person. Again, information must be reliable. So reliability means that it should be dependable. In other words, it must be free from material misstatement. It must be free from errors. So if a management accountant consistently reporting the content is always full of errors, grammatical errors, not properly structured, and nobody wants to rely on that kind of information. So it's important for you to know whoever you're communicating to, you must always ensure, do proofreading, check it yourself that if this information presented to you, will it of value to you? Can it be reliable? Okay, so reliability means that you have to make sure that errors are out. Of course, it's a human institution, it's a human work. You are likely going to have some errors, but we are saying that it must not be of material errors. It must not be of material misstatement. That's why in the financial statement, it says that the account does not have any material errors or material statement, therefore makes it reliable. It must also be understood. Okay, so understood here means that whoever you're communicating to must understand the language for which or with which you are reporting. Okay, so you don't go and use some ambiguous words that have multiple meanings, words that are not understood, words that the person may have to go and pick a dictionary to look at what you intend. Use simple, straightforward language, because the person doesn't have time to go look for dictionary, encyclopedia to make meaning of your words. It must be in simple, direct language, straightforward, so that the person read it, get the understanding, picks up, and make the relevant decision. Again, the information that you're communicating must be timely. If it has to be in the next 1 hour, it has to be in the next 1 hour, because it's always said that information delayed is decision delayed. Because if the information needed for a decision and you have delayed the delivery of that information, obviously you're going to delay the decision. And of course, if a decision is delayed, the outcome, the output is also going to be affected. All right, you must be neutral. Don't report in a manner that favors you. Don't report in a manner that favors certain group of persons or parties as against other parties. You must always be in the middle. Whatever it is, even if it's going to cause your job, you have to report it the way it is. Do not be discriminatory. And must also present it on a faithful basis, faithful representation. Give the fact, give the truth. Whatever it is, you have to say it. In accounting, it says that you must present the commercial substance, the reality of the substance, the reality of the transaction, and don't look at some other legality. Don't look at other composition that may put color. Just present it as it is. Be faithful with your reporting. Right. Now let's look at the final issue in this presentation, and that is cost classification. Of course, we know what cost is, as we saw from the previous discussion, or from previous slides. I said that cost the amount of expenditure incurred in bringing an item to a present location or condition, or cost the amount of expenditure incurred actual or notional in producing an item or service. Of course, this cost can be divided into various components. This cost can be grouped in terms of likeness. This cost can be grouped in terms of for whatever reason. Okay, so whatever reason or whatever purpose that or whatever intent that the cost is needed for, you can put them in different form, just so you'll be able to achieve what is intended for. All right. So cost can be classified into 4 main areas. So you have cost classification by nature, cost classification by function, you have by decision making, and also behavior. So there are 4 main classification of cost. we're going to take a look at what each of these classifications would represent and what they're meant for and how managing accountant can adopt them in your analysis and decision making to your management. Now let's begin with the cost classification by nature. So by nature, the cost of a product or service is determined with reference to the cost element. So here the key word or the key phrase here is what cost what element. So if I want to find, let's say, the cost of a table, and I want to look at the classification of the table. So let's assume that the cost of a table is 100 cedis, right? I want to find out the cost, what make up the 100 cedis. So if I want to find out what make up the 100 cedis, we are saying that you can look at it in terms of nature of 100 cedis, that's making up the cost of the table. You can look at it in terms of the functional responsibility of the entity. You can look at it in terms of decision of the same 100 cedis and also what by behavior. Okay, so by nature, we are looking at the cost of 100 cedis of a table in terms of the cost element, the makeup, the composition of what? The table. So what and what make up a table? Of course, if you look at a table, you can say, okay, a table is manufactured by using wood or certain materials. Now, before the wood were converted to the complete product as table, we needed what? Human effort or maybe some machine services and some other expense like lights and maybe sandpaper or glue or nails that have to come together to produce a complete or table or complete or chair. The cost of the table and the elements of the table into those categories. That's what I mean to say that cost classification by nature. So when we talk of cost element, there are three main cost word element. We have material cost, we have labor cost, and we also have what? Overheads or expenses. Three cost elements. We have the material cost, we have the labor cost, and you have other what? Expenses. So you're going to take a look at what each of these what means. First, material. So materials are the cost components. All right, so the components or the items that are used to produce. So you can say the raw materials or the raw source or raw components or the raw items that are used to produce the finished product is what referred to as what? Materials. So let's say if you're producing again a table, you're producing a chair of wood or made of wood, we can say that the wood, which is a component for producing the chair, the wood, which is a component for producing the table, represent what? The materials. Okay, so here is an example. Wood, nails, glues are the material for producing chairs or tables. So these are the raw components, these are the raw source that are used to that are converted to produce a finished artwork that are put together to produce a finished artwork in the form of what? Of a table. Right, now, this material cost again can be broken down into two. So you have direct material cost and indirect material cost. Now, direct material cost means costs that are directly attributable to the finished word product. Okay, so when you take the finished product, you can always identify the material with the product. So if you take, let's say, the table, everybody looks like a table and see that, okay, the table is made of what? Wood. Everybody looks like a building and say that this building is made of plastics, or the building is made of cement, or the building is made of what? Blocks. Okay, so whenever you watch the final product, you see a particular material is made of that kind of final product. Okay, so the materials which are identifiable, which is attributable to the final product, is what is referred to as the direct material. Again, when you pick the same final product, there are some other materials that were equally used, that were equally applied, but you cannot identify them with what? With the final product. We cannot identify them with, let's say, the table as a finished product. So when you pick any table that you are close to, everybody knows that, okay, that this table was made of wood, which is the direct material. But you and I also know that sandpaper was used, glues were used, nails were used, and other materials were used, but you cannot see them anywhere around what the table that is about manufactured or that is produced. Those non-identifiable materials are what referred to as what? The indirect material cost. Okay, so we are saying that we have the cost by nature made up of material, labor, and expense. And by material, we have direct material and indirect material cost. So all other cost elements, what is labor, also have direct labor and indirect labor, and anything or any cost which is not material, which is not labor, will now be referred to us as an expense. Okay, so in production of, let's say, the same table, we are going to incur other expenses, such as what? Maybe such as lights, such as other expenses. But these expenses are neither labor costs, neither are they material costs. So once they are not labor Once they are non-material, they fall under what? Expenses. So labor cost is any cost that is coming from the human effort. So the human being services that are using to produce the final product, the cost that is payable to these human beings or in return for the human effort or services is what refers to labor what cost. So and the labor, you have labor which is direct. So if let's say take as far as provide professional services, provide professional tuition, provide consultancy. Okay, so those labors, those individuals that are directly involved in the consultancy like myself, that constitutes what in the direct labor what cost. But of course, when you go to Aspire, you also have other individuals who are working for Aspire. But those people are not directly related to the direct service or provision. And those ones are rather referred to as the indirect or labor. So, for example, the service of the secretary or the service of the IT personnel, all these guys are helping one way or the other, but they are not directly involved in the production or meeting the clients or you meeting the student directly. Then, of course, other than the labor, other than the material, are those expenses. So, you also have direct expenses as indirect expenses. Now, if you look at it, so we have direct material, direct labor, direct expenses. We also can have indirect material, indirect labor, indirect expenses. Now, when you put all in terms of your costing, which means determine the cost of the table. So, if I want to determine the cost of the table, I can decide to put the material cost plus the labor cost plus the expenses. I can decide to break them in terms of direct and indirect. Now, when you add all the direct costs together, which are made up of direct material, direct labor, direct expenses, together is called prime cost. Okay, but when you rather add the indirect labor, indirect expenses, indirect material together, we have what is called the overheads. Now, the same cost can also be broken down to different places. So you can have labor and other expenses put together. All right, labor and other expenses put together, other than material. So take the material out. So you have just the labor and other expenses put together. Those labor and other expenses put together is referred to as conversion cost. Plus the material cost is a make up the total cost. Okay, so the same cost can be analyzed into raw costs, which are material, labor, or direct cost or prime cost plus overheads, total cost. I can also say material cost and what conversion cost also give you the same total cost. So in terms of the costing structure, like we said earlier on, you can have material, labor cost, expenses will give you the total cost. Alternatively, you can say the prime cost, which is made up of all the direct material, all the direct labor, all the direct expenses, then the overheads, which is made up of all the direct material, all the indirect expenses, and all the indirect material and labor costs. That's the overhead. Or you can also say that, okay, material cost plus the labor and expense. So the labor and expenses put together refers to as a conversion cost, or the labor and every other than material cost. Okay, so if your total cost, let's say 100 cedis, material is 20 cedis, labor is 50 cedis, and other expense, let's say 30 cedis. The 50 cedis plus the 30 cedis, excluding the material, is referred to as a conversion cost. Then, so when you add the conversion cost and material cost, then you're going to have the total production cost. Now, let's look at the other classification by function. So, you're looking at functional classification in terms of the company setup, company departmentalization. And oftentimes, the classification by function will only be seen in the income statement structure. So, you realize that when you prepare your income statement, you're going to have, let's say, your production cost, you're going to have, let's say, the cost of sales, you're going to have, let's say, selling expenses, finance costs, administrative costs. That's the functional classification. So, it depends on how your company is set up and is subdivided into various departments or functions. Okay, so those are examples of cost classification by function: production, finance, administrative, selling costs. That's how I'm going to do the classification. Then by decision making, of course, this is core to man accountant, because we're saying that for man accountant, your core functions to deliver information for decision making purposes. So it is therefore important for you to know how you can classify your cost for decision making purposes. Of course, I said the import is that costs that cannot be influenced or changed by choices are not considered for decision-making purposes. Remember, one of the features of good information that must exhibit relevance. Okay, so we are looking at all those costs that are relevant, all those costs that are not relevant, all those costs that are avoidable. So in terms of your decision-making cost classification, you can have relevant costs versus irrelevant costs. We know the meaning of relevance. Relevant means it can be influenced. Relevant means it can change our thought, it can change our judgment. Or avoidable costs or unavoidable costs. If a decision can change a cost, it's avoidable. But if the decision cannot change the cost, it's unavoidable. Okay, so for instance, if let's say you have paid to Aspire to enjoy their e-learning services, you have already paid. And suddenly you decide, okay, I'm not writing the paper again, so I'll no longer subscribe to the e-learning services. As long as you are paid, and to the extent that you are making decision of not to learn anymore, and what you are paid cannot be changed, as far as will not refund your money to you, that kind of cost which will not change regardless of decision are referred to as unavoidable costs, or can also refer to as irrelevant what costs. And those costs you have already paid are also can be referred to as sunk historical what costs. They also refer to as uncontrollable what costs. All right. So in this case, all the costs that are relevant for decision can be referred to as relevant costs, avoidable costs, controllable costs. But those who cannot be, which are not adopted or which cannot be used for decision-making purposes, are rather referred to as irrelevant costs, unavoidable costs, historical costs, or perhaps committed what costs. Right. Then finally, we look at the other classification by what behavior. So classification by behavior, looking at whether or not cost is subject to changes when production levels will change. Whether cost is subject to a movement. Whether cost is subject to what a shift when activity levels or production levels or when decisions will change. Okay, so if let's say your cost is 100 cedis for producing 1,000 units of something. Now, if you produce more than 1,000 units now, will the cost of 100 cedis change or will not change? Okay, so looking at the extent to which cost may likely change when your activity levels are also changing. Some of the costs may change and others may not change. So in terms of changing or non-changing behavior of cost, we can look at it in terms of variable cost, fixed cost, semi-variable cost, and semi-phased cost. Right, now, let's take a look at each of these cost elements or cost behavior. Now, variable cost here means that a cost, as the name refers or represents, variable is changeable. All right, so all variable costs are subject to change when activity levels will change. All variable costs are subject to change when your decisions also will change. So variable costs are costs that are expected to change in direct proportion to changes in output or activity levels. And you must note that when an organization is not producing, when production levels are zero, variable costs are equally what? Zero. So variable costs will always start when production will start. When production stops, variable costs also what? Stops. All things being what cost. So that's the curvature. That is the chart representing variable cost. So you can see that cost on the y-axis and volume on the x-axis. So the difference between the two is that the x-axis is an independent variable, which represents the output of volume, and the cost represents the y-axis, which represents the dependent variable. So as and when volume start is zero, cost is equally zero. But when activity moves to 1, 2, 3, 4, cost also start becoming what? Positive. And when production stops, costs also what? Stop. And so that's the nature of what your variable costs. So variable costs are usually influenced by two main variables. One, the variable cost per unit, and also the total what production. The variable cost per unit and the total production. So every time I want to determine your variable cost, you must have two key things in mind. The variable cost per unit. So let's say every time you produce an item, your variable cost per unit is, let's say, 2 cedis. Okay, so if you're producing X quantity, the total variable cost will be equal to 2 cedis by the X what quantity, all things being equal. Then you have the fixed cost. So we will not say that because variable cost is a cost that changes when activity levels change, fixed cost rather be the cost that will remain unchanged when activity level will change. No, it doesn't mean that. You must always have proper interpretation of fixed cost, the concept of fixed cost. Fixed cost, a cost is said to be fixed within a certain time range or within a certain time period. Variable cost more or less is a long-term cost, but a fixed cost is a short-term cost, because in the short term it is said that some of the factors of production are regarded as what? Fixed, are regarded as what? Unchangeable. So let's say land, in the short term you may not be able to expand the size of the land until you give yourself some time to come, so you can have access to other lands and put them together to increase the production level. So fixed cost is a terminology that is usually represented in the short term. In the long term, all costs are regarded as what? As variable. Okay, so when you say fixed cost, a cost is said to be fixed within a relevant time. A cost is said to be fixed within a certain time period. So within this time period, that's when the concept of fixed cost becomes relevant. Now, this fixed cost can also be said to be a cost that remains constant or unchanged within, a certain level of production capacity. Okay, so let's say you have a room that can occupy 20 students. All right. Now that room, the rent that you have paid is fixed. Let's say 1,000 cedis for a room for 20 students. Now, if you have 1 student, the same rent will remain the same. If you have 2 students, the rent remains unchanged. If you have 10 students, the rent will change up to the 20th student. Now, when you have 21 students, the additional 1 student you have added cannot fit into that room. You have to get another room to make provision for that one other, added student. So it means that within the relevant range or within that capacity of 20 students, within that capacity of certain amounts, the cost remain unchanged until you exceed the capacity level. So that's how you must always explain the concept of fixed cost. It is fixed, it is constant within a certain time limit. It is fixed within a certain time, certain production. But when the production level capacity, then of course it's going to change. So fixed cost can never be zero. Fixed cost can never be zero. So whether you produce, you do not produce, fixed cost would always be positive above the zero line. But of course, realize that it remains flat. But when it changes, then of course the fixed cost is going to also change. When you go beyond your capacity, the fixed cost also would also change. Then you have semi-variable cost. Of course, so when you add your fixed cost and your variable cost together, it refers to that as semi-variable cost. So semi-variable cost means the sum of your fixed cost and your variable cost. Then the issue of semi-fixed cost. Of course, so if you look at fixed cost, we are saying that in the case of the 20 students and 1,000 cedis as paid as rent for the room, up to 20 students, the rent remains the same as 1,000 because they are still going to be occupied or still going to be contained in the same room. But when you have 21 students, that additional one student would have to go to another room. That means you have to pay additional rent. So it means that for every 20 students, you have to need another room. So the first 20 in one room, the next 20 has to go to another room, the next 20 will have to go to another. So it means that every capacity, you're moving beyond your capacity level, beyond the expectation. This cost is flat. The variable cost always start from the origin. Of course, we have what cost. So cost what point? Like you said, reserve. So as long as you know that your total cost is equal to your total cost zero. So the starting point of your total cost line is your fixed cost. But the movement in your total cost is triggered or is changed by the total variable cost. So it means that every time your total cost changes, the change is triggered by what? The total variable cost. Type of fixed cost and variable cost is 106.
Thank you for watching another video from Aspire Professional Consult. For more of these videos and audio lectures, you can join our e-learning program by downloading our app on both Android and iOS. For those of you who want to join our classroom lecture, you can also join us on both weekends and weekdays, either at Kwabenya for the weekends and Accra Central at the Hockey Stadium for the weekday. And also, we give you an opportunity to buy books from our published house, that's Aspire Publication, by dialing the following numbers provided on your screen. Thank you, and see you in our next section.